In today's video, we are going to look at a case study in which an individual has a lump sum of money. He has a total of $200,000. He'd like to move it into a whole life insurance policy as quickly as possible. His goal is, of course, to maximize the cash value. So we're going to go through exactly how he can do that, and then also some additional items to be aware of, particularly after the policy is set up, what you need to be aware of as the policyholder, the consumer, and then also what the life insurance agent needs to be aware of with respect to making the proper adjustments. So what we've got here is a case where an individual wants a whole life insurance policy specifically for the cash value benefit. We often hear this with individuals we work with. Someone will outright express, I'm interested in the product, I'm interested in the cash value, I don't really care about the death benefit, at least not right now. In many cases, the death benefit does provide value long-term, but the cash value is the main point of focus. So the whole life insurance product, when we look at the cash value, what are the benefits? Safe, liquid, and tax-free. Tax-free if we don't trigger a taxable event. However, with a whole life insurance policy, often one thinks, I have to make premium payments for my whole life. I don't want to do that. So can I have a policy where I only make a lump sum payment of $200,000 and then I am not required to continuously make premium payments forever up until the day I die? Because a traditional whole life insurance policy will state that premiums are due for your entire life. For example, if we look at a whole life 95 policy, what that 95 represents is the age that premiums are payable until. So we have someone who's 40 years old. He's taking out a whole life 95 policy because that maximizes the cash value on a guaranteed and non-guaranteed basis. He can fund it just for 2 years, like what we're going to look at. But when we read the actual illustration, when we read the formal contract, when we look at his online portal, after he starts the policy, the insurance company states premiums are payable up until age 95. Let me show you a quick example of that. So if we take a look at an illustration, this is what he wants to do. But let's take a look. What do you notice? Under whole life 95, we see 4 bullet points. Look at the last bullet point. Level guaranteed premium payable to age 95. If we were to look at the formal contract, we will see that premiums have to be paid up until age 95. But he doesn't want to do that. So it's very easy to accomplish what he wants to do. So if this is you, can you have a policy, this whole life 95 product, which I am a huge fan of, can I have a policy where I see this? My net after tax outlay is a total of $200,000. We spread it out over 2 years for efficiency and then never have to make another payment. Can we do it? The answer is yes. Here's how we do it. So let's first begin with exactly what the individual wants. So this is what I want. If this is you, a 40-year-old individual, I've got $200,000 in cash or in another asset. I understand the benefits of a cash value life insurance policy. I see that it's safe money, grows tax-free if I don't trigger a MEC or another taxable event, and I can use it like a personal line of credit, perhaps for real estate investing. That's why I'm interested in the product, but I'm not attracted to the idea of having to continuously make premium payments. So can I do this? Here's my annual outlay. This is the illustration we just had up. Total of $200,000 paid into the policy. Year 3, nothing paid in. Cash value continues to appreciate. What's highlighted here in yellow in year 4 is your break-even point. When your cash value is equal to or greater than your total payments. By the 4th year, we've recaptured everything. Annual internal rate of return, the net growth rate on an annual basis. And then we've got the same thing here, but in dollars. So for example, if I look at year 4 to 5, my cash value was $200,000. It has appreciated to a little bit more than 205, just about 206. So if I were to take a calculator to that, I would see that the growth rate is about 2.78%, which comes out to just about $5,600. And again, I've got the tax benefits there. I can access it. So if I've got money in cash, what a lot of people will express is that this is a fantastic alternative to liquid money that, again, I want to have access to for opportunities, but I actually see it grow over time. So this is what I want. Can I accomplish it? The answer is yes. And here's exactly what I've got when I look at the numbers. Let's hit on some items of awareness though, because this is very important. And we explained some of these features in our last video. What do we see here? Well, we've got a whole life 95 policy, which means again, premiums are payable up until age 95. We will see that in the contract language. We'll also see that on our online portal. Action items to be aware of. If this is you, funding $100,000 years 1 and 2, we've got these different terms here. Premium offset, automatic premium loan, and reduced paid up. If the plan is truly to fund a policy at $100K per year, just years 1 and 2, and then nothing thereafter, here's exactly what I would do. I would fund it years 1 and 2, then beginning year 3, I would exercise a premium offset, which allows the policy to pay for the premium through dividends and interest. Let's take a look here. So on the example that we just looked at, what I want, it's demonstrating that. The issue with this Excel workbook is we don't see the premium here. So let's go back to the illustration we had up before, which gives us a formal breakdown as to where the money is going. After-tax outlay, your actual out-of-pocket each year, 100K per year, and here are your total payments. This represents cumulative net after-tax outlay. Stops at $200,000. Year 3, we see a 0, so your actual out-of-pocket is nothing. However, look to the left. What do we see here? Under this column, base policy annual premium. So in year 3, what's happening here is the base premium of $10,000 is still due. We still have a term insurance rider attached as well, which we need to keep on to prevent a MEC from occurring. The cost of that term rider is several $100s, not super expensive, but that also needs to be paid. However, if this is you, what's your out of pocket? 0. You don't pay anything in this case. So what's happening here is the earnings in the policy, both the dividends, which this only reflects the surplus, not the total dividend rate, this column. So the earnings, the dividend piece, and the guaranteed piece will help support that premium. And what I want to see is my cash value continuing to appreciate, meaning the policy can cover the internal expenses and continue to produce a positive cash value gain. I do not want to see it go backwards. How you put yourself in a position like this is by really heavily overfunding the PUA rider, which here we see 100K going in. We've got that premium close to the minimum at 10%. I'd actually drive that down a little bit lower with this company as we can illustrate just about a $9,100 base premium. We've got a clean 10,000 here, but we want to drive it down, get more money into PUAs, and this is what puts me in a position where if A, I want to stop funding, just like we see here, we can do that. B, if my plan is perhaps to continue to make payments, but then life happens and I cannot make payments, well, now I'm in a position where I can exercise this, which happens on occasion. It's rare, but it does happen where someone has a plan to make payments to a policy for a long period of time. Something happens, they can't pay anything. If the policy was properly designed and we've got cash value in there, we see it continue to appreciate over time. If I've taken maximum loans and I can't pay anything, that's where I could run into an issue where we've got to take a look at different strategies. We see number 1, premium offset. And then what would we do next? We would not look at an APL, reduced paid up, and the earliest we can exercise that is policy year 8. So that reduced paid up option, what this does is eliminate the premium altogether. So on the illustration here, we see years 3 through 7, the premium is due, but we are not paying it. The policy is funding itself. In year 8, that premium is gone. We see up here, we exercise this reduced paid up option. So what did we do here as far as action steps are concerned? If you're an agent, you want to be aware of this. If you are a policyholder, if you have an existing life insurance policy already and you're working with an agent and this is something that you want to do with your policy, perhaps now or in the future. Here's some of the terms or just some awareness you want to have or provide to your agent. Premium offset occurred first. We don't see this on the illustration. So we exercised that premium offset, we'll call it PO, years 3 through 7 in this example. To actually exercise that premium offset, the agent must reach out to the insurance company and make that change. Typically, with most insurance carriers, paperwork does need to be signed by the policyholder, the policy owner, in order to actually make sure a premium offset occurs. If a premium offset is not exercised, meaning if we don't exercise that transaction in year 3, what'll happen in most cases is option 2, if we go back to the whiteboard, which is an APL, that automatic premium loan. So what happens in that case, the premium's due, but the policy will loan against itself, will take a loan against the cash value to pay that premium. And that's not always a bad thing. There are some advantages with an automatic premium loan. We will see people do that if they want to finance the premium. For example, if you said, hey, that $10,000, I can pay it and I want to pay it, I just can't pay it right now when my premium's due. In 6 months, when I sell a piece of property, I'm going to be able to do that no problem. This is a common case where we'll see someone exercise an automatic premium loan. They'll have a loan, pay the premium, then they pay their loan off 6 months later. And what we see is the cash value restored to a very similar figure as what it would have been if I would have paid the premium in the first place. So again, a good option to be aware of. But my point is, if we don't manually exercise that, even though we set the policy up just like this, when year 3 comes, we still have to manually make the change. It is not automatic just because we submitted this illustration to the insurance company when we first started the product. Very important to be aware of that. Same is true of year 8 with that reduced paid up option, where we elect to eliminate the premium and we forfeit the right to add more money into the product. Now we can loan and repay loans all day long, but when we exercise that reduced paid up, what happens? Term rider's gone, death benefit drops, cash value performance will pick up. And we can see that too. In fact, let's go back to that option there. Look at your internal rate of return. A lot of people are attracted to this option for this reason. Once we exercise that reduced paid up, because we're eliminating the premium, we're eliminating the term rider, I like to refer to it as cutting the drag. Once we cut that drag, our cash value can grow at a faster pace here. And we'll see this to be the case based on the guaranteed values as well. So good to be aware of this if I want to maximize cash value. What's also important to be aware of is the fact that it has to be exercised by the agent. If it's not, it will not automatically occur. So very, very important there. So let's take a look here at a couple things. On the left, what do we see? Policy is payable until age 95. So this is your plan here on the right. But to the left, let's say you fund years 1 and 2. Here's what the illustration will look like, the formal illustration from the life insurance company. And when you look on your online portal, you'll see this base premium still due every single year. If you do not pay it and no action is taken by you or the agent, the premium is still due, and that automatic premium loan will occur, which we don't want that to occur for years on end without having any awareness on it, because what happens is loan interest accrues, and if I'm not paying that out of pocket, the policy will also borrow against itself to cover the loan interest. I want to be aware of that. Some people will look at automatic premium loans and then pay them off later. But again, I don't want to run into a big trap where all of a sudden I got this huge loan bill and I wasn't aware of what was going on. That's the big thing there, and monitoring the policies over time is important. So here we see it constantly being paid. Here's what he wants to do. Fund it for 2 years. We see the premium still due. He's not paying it. His net out of pocket is 0. There's the cash value performance. This is the example we just looked at. And from an awareness perspective, don't overlook the details. And this is more so for the agent. So this will assume that step 1 is completed, which is the premium offset in year 3. However, What do you notice differently about this? After year 7, you see the term rider is cut. However, this premium is still due. So what happens is we see that the policy can continue to exercise that premium offset where it covers the premium internally for a prolonged period of time, continues to compound, which is fantastic. But how does it look when we compare it to the example where we exercised a reduced paid up? We see a noticeable difference in cash value. And we're going to look at the guarantees in a minute as well. We'll wrap up with that. But with this, what I'll add is keeping the premium here through this offset. This can be a good option if you feel that you may want to continue to make premium payments in the future. So I might exercise a premium offset up until 50, and then I say, you know what? I'm thinking about a new policy, but I still have this one. Instead of starting all over and going through the expenses again, can I just add more money to this? The answer is yes. You can start to make the premium payment again, no problem. You might be able to add more PUAs as well. That may require underwriting, depends on the insurance company and PUA rules and such. But my point is, if the premium is still due and it's being paid through dividends and interest, or if it is being paid through a loan, it's still active. I can elect to pay it with my money, out-of-pocket funds. If a reduced paid up has been exercised, it's done. But then I get maximum cash value performance from an internal rate of return standpoint. So again, I want to be aware of that. But here, if I forget to exercise the reduced paid up and the individual has zero intention of making premium payments again in the future, can end up hurting me or hurting the policyholder. Let's wrap up with the guaranteed values. Exact same thing here. And this is where it's really important to see the options. So here's what I want. Funding it for 2 years, and this is the guaranteed rate only, worst case scenario, breaking even between years 10 and 11. And that's with the premium offset and then the reduced paid up. What happens if I forget to exercise the reduced paid up? Base premium still due. You don't see it eliminated like you do over here. Based on the guarantees only, we cut the term rider, but what ends up happening here, cash value goes up, then hovers around 186 for a long time, then starts to come down. And what's down here in red is a point in time where the policy is calling for more premium, meaning I have to make payments in order to keep the policy in force, or loans will begin to occur where that automatic premium loan will occur because there's not sufficient cash value and it's starting to come down, which we do not want to occur. So a reduced paid up will fix that. But if I just forget or neglect the policy, that's where I can run into an issue. So hope you enjoyed this video. I had a lot of fun with it. If you did, please hit the like button, subscribe for more, and we will see you in the next video. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.